Good afternoon, my name is Michael, and today we'll be discussing the Catalyst Credit Opportunity Fund, which ran from 2017 to 2020. So, our thesis was that the Fed would increase rates back to normal, and companies with financial resilience wouldn't face this credit stress and would be indiscriminately sold alongside the companies that genuinely face credit stress, and that they would be repriced due to a catalyst. However, COVID wasn't a credit stress situation. In fact, it was the complete opposite. Rates fell back to near zero. It took 6 years for the macroeconomic conditions to be conducive to the thesis, where the Fed increased the rates to 4% in late 2020. This is where the fund had a 21% point outperformance compared to the S&P, because the macroeconomic conditions were what the fund was designed for. However, in the 5 years prior, the fund trailed behind the S&P and absorbed worse than index drawdowns in COVID. And the generated returns were driven by systematic factor tilts rather than the high yield mechanism that the thesis relied on. In the 6 years, the S&P saw prolonged growth and a technological bull market, things our fund weren't designed to capture. The COVID-19 was a supply shock rather than a credit cycle event. This was not captured in our fund. The result of this was a 71% cumulative return and a 73% cumulative return on the S&P. This meant our fund had a 32% shortfall. Below is a chart of our fund, the S&P, and a 60-40 blend of the S&P and bonds, index to 100. In 2017 and 2018, all three lines moved together. Our fund isn't underperforming yet. The divergence happens in 2019, where our fund flattens. In 2020, the growth stocks and the tech bull market that were in the S&P recovers after COVID, whereas our portfolio doesn't contain these stocks and lags in recovery. As rates normalize closer to 4%, the three lines converge close together. In our opening year, the market ran on Trump's tax reforms and high yield compression. Our value-orientated, event-driven position simply didn't capture this expansion that was in this bull market. This was expected and consistent with our thesis. In 2018, the fund had its first real test. The Federal Reserve raised rates aggressively throughout the year, and by Q4, markets decided that the Fed had gone too far. Equity sold off, the credit spread widened, both the fund and the S&P were negative. But we lost 3.5 against the S&P's 5.4. A modest improvement, but an improvement. The thesis said we should hold up better when rates rise and credit tightens, and we did, marginally. The honest caveat is that the stress was short-lived and relatively shallow. The spreads widened briefly and then recovered. It was encouraging, but not conclusive. A practice run for what 2022 would eventually deliver. 2019 is the most uncomfortable year to explain, because on the surface, everything should have worked. The M&A acquisitions were booming, and our companies executed acquisitions and spin-offs, and the rate pivoted to rate cuts. Conditions that the thesis said would generate strong catalyst-driven returns, and yet we returned only 8.9% against the S&P's 28.9%. The catalyst fired, our re-ratings largely didn't. The reason is that 2019 was a growth and movement market. Investors weren't driven by value and financial resilience or event-driven stories. They were chasing technology and growth stocks, which simply weren't in our portfolio. In March 2020, COVID hit, and the fund fell rapidly alongside the market. Whereas the S&P roared back to life, driven by growth and technology stocks, supercharged by the Fed stimulus. None of these stocks were in our portfolio. We were positioned for credit stress resilience, not liquidity-driven growth. So as we fell, the market slowly recovered, and we ended the year at a negative 4.7% against the S&P's 16.3% recovery. The deeper problem is that COVID wasn't the type of stress our model was designed for. The Zemajuski model screened for financial resilience against credit stress deterioration. COVID was an overnight revenue collapse hitting every company simultaneously, regardless of how good their balance sheet was. The model screened for the wrong risks, and the drawdown showed it. In 2021, we produced near identical returns. There was an M&A boom, there was broad market strength, and that just lifted every value stock. We essentially matched the market. Neither good news or bad news for the thesis. 2022 was the year that the fund was built for. The Federal Reserve began the most aggressive credit cycle rate in decades. Growth stocks collapsed under the weight of high discount rates, and investors rotated hard into quality and value and financially resilient companies. Everything with the thesis, every filter, every analysis that we put into this paid off here. The radar chart tells the other side of the story, and this is where our fund makes the strongest argument. 6 metrics and the 2 polygons presented here. The shape of these polygons tells exactly what type of fund we are. The S&P's polygon extends further in absolute return, but the Sharpe ratio of our polygon extends substantially further. We get a 0.28 against the S&P's 0.13 in Sharpe ratio. We delivered more than twice the risk-adjusted return per unit of total risk. On the Schrodinger's ratio, the same story. 0.18 against 0.08, more than double the S&P when measured specifically against downside risk. The maximum drawdown is where it matters. We promised our investors that this would be a safer fund than the S&P. But due to COVID, there was significant stress on our fund. We didn't screen for the stress that COVID provided. It was more the credit risk that we had anticipated. Now, overall, this shows exactly what type of fund we are. We exchanged a lower ceiling of returns for a better risk characteristics across most dimensions, a tighter, more disciplined portfolio that earned superior risk-adjusted returns, not through the mechanism described, but the wrong kind of crisis arrived. This chart is the most direct test of our Zemajuski screening thesis and delivers the most direct challenge to it. Look at the bottom panel. The COVID stress window from February to June 2020. Our fund troughed at approximately 30%, and the S&P troughed at 20%. We drew down approximately 10 percentage points more than the market. In the exact scenario our financial resilience screening was designed to protect against. The Zemajuski model was calibrated to identify companies that are unlikely to face financial distress during a credit cycle deterioration, rising defaults, fund pressure, and earnings compressions unfolding over quarters. It measures leverage, interest coverage, liquidity, and profitability, all valid inputs from a credit cycle stress test. COVID was not a credit cycle stress test. COVID was a revenue collapse that affected every company simultaneously, independent of their balance sheet strength. McKay had real estate assets and a strong Zemajuski score. Those assets don't help when the government closes every store in the country. Gillard had no debt problems and enormous cash generation, but that doesn't help when healthcare sentiment collapses and biotech faces repricing pressure simultaneously. The model was screening for the wrong risk. Now, if we look at the full panel, specifically on the right-hand side, 2022, the fund's drawdown is materially shallower than the S&P during the rate hike correction, approximately 12% against the fund's 24.8 from the index. This Zemajuski screening worked as intended in the correct environment. Now, our distribution with the S&P looks quite similar on paper. The S&P's mean is slightly higher, its median is significantly higher, the standard deviation is relatively the same. The main difference is the kurtosis. We're an event-driven fund, so our returns looks like nothing happening, and then boom, an acquisition or a merger happened. So that's why our funds look a little different. Now, this chart answers precisely the question of the returns that we generated each year, how much came from systematic factor exposure that any passive fund could have captured, and how much came from genuine stock selection skills. The color bars show what drove it. The headline number at the top shows that this model explains 81.9% of our monthly return. This high R squared tells you that our portfolio was substantially driven by factor tilts, not pure stock selection. 2 years stand out specifically. 2020, look at the massive negative light blue band. This size factor works against us. In COVID, recovery rewarded smaller, more nimble companies over our large cap concentrated holdings that absorbed the headwind fully. Now, in 2022, look at the enormous positive light blue band above the line. That's the investment quality factor, CMA, having its best year in decades, as rising rates reward financially disciplined companies. Our screening loaded us heavily towards that exact factor tilt. The alpha T statistic of negative 0.83, well below the threshold of 2 needed for significance, means that we cannot claim a statistically significant alpha. Now, this graph is a direct test of if we generated money through the mechanism that was described in the thesis. That is, when high yield spreads widen, the credit stress rises and financially weak companies suffer. Our Zamajuski screened profile insulated us from that pressure, and we should have generated positive residual alpha above what this factor model predicts, the 5 French Farmer. If that chain holds, then the scatter plot should slope upwards. Our alpha should rise along up the vertical axis, and the data should cluster in the top right-hand corner. But as we can see here, the trend line slopes downwards, and we have a p-value of almost 0. So what we can conclude from this is that the mechanism that we predicted does not work in this environment, and that the transmission channel that we described was not accurate in this environment. The mechanism that we generated alpha from was the factor tilt and the idiosyncratic catalyst events. Both are legitimate, but neither is what we claimed.